Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Lululemon, the premium activewear brand known for its yoga pants and lifestyle apparel. The stock has been under heavy pressure in 2025, down about 50% year to date, after management cut full-year sales guidance and US same-store sales growth slowed to a crawl. We're going to break down Lululemon stock using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Great businesses start with efficiency. If a company can't earn strong returns, nothing else matters. Let's look first at return on invested capital. Lululemon comes in at 40.4%, far ahead of competitors. Nike is at 29%, Adidas at 8.4%, and Under Armour at 6.6%. Next up, return on equity. Lululemon also shines here, posting 42.4%, compared to Nike at 40.1%, Adidas at 14.2%, and Under Armour at 11.3%. These numbers show Lululemon is not just profitable, but extraordinarily efficient compared to peers, a sign of strong margins and efficient capital use. Returns today are nice, but without growth, the compounding machine stalls. Over the past decade, revenue grew at a compounded annual growth rate of 19.9%. Net income grew at a CAGR of 23.8%, and earnings per share grew at a CAGR of 25.5%. Earnings per share growth has outpaced net income, thanks to share buybacks reducing the share count. This consistent above-peer growth profile has been one of Lululemon's strongest calling cards. Even the strongest business model can crumble under weak balance sheets. Here's where Lululemon stands. As of 30 June 2025, cash and short-term investments were at $1.2 billion, total debt at $1.8 billion. And looking at year-end 2024, cash was at $2 billion and total debt at $1.6 billion. That shows some deterioration. Debt has risen while cash has fallen. Debt to equity is 0.4, trending upwards since 2020 but still at a healthy level. At year-end 2024, free cash flow of $1.6 billion fully covered total debt of $1.6 billion, a very healthy cushion. Overall, Lululemon's leverage is modest, and debt remains well covered by free cash flow, though the trend in 2025 points weaker. Even the best companies can be poor investments when investors overpay. So how is Lululemon valued today? Lululemon trades at a price-to-earnings ratio of 11.6. When we look at peers, Under Armour trades at 20.9, Adidas at 27.3, and Nike at 32. So Lululemon looks cheap on this measure, but to adjust for growth, we use the PEG ratio. The long-term earnings per share growth estimate is 8.3%. This gives us a PEG ratio of roughly 1.4, which suggests Lululemon is reasonably priced given its growth outlook. On the short term, the earnings per share forward 2-year growth is minus 4.8%, which reflects current headwinds, but long-term growth expectations are more useful for valuation. This highlights the disconnect. The market is pricing in near-term weakness, while the long-term fundamentals look intact. A moat protects profits from competitors, and Lululemon's moat is strong, but being tested. Lululemon has a premium brand with loyal customers, and an industry-leading efficiency shown by top-tier return on invested capital and return on equity. But there are some risks. First up, tariffs. The end of the de minimis exemption, which previously allowed imports under $800 to avoid tariffs. This could cost Lululemon $240 million in 2025, rising to $320 million in 2026. That's a direct hit to margins, forcing either higher prices or lower profitability. Next up, US softness. Sales are flat in its biggest market, with management admitting its casual lines became too predictable. To fix this, Lululemon plans to add more new styles, but that means selective price increases, which risk alienating cost-sensitive shoppers. Finally, competition. Nike and Adidas have broader global scale and Under Armour has stronger sports heritage. In short, Lululemon's moat is strong within its niche, but less diversified than Nike or Adidas, making it more exposed to tariffs and shifting US consumer trends. Now before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. In my view, Lululemon looks undervalued, but with risks investors need to weigh carefully. Return on invested capital of 40% and return on equity of 42% show elite capital efficiency, well ahead of peers. Lululemon has strong double-digit CAGRs in revenues, net income and earnings per share over the last decade. Debt is rising, but coverage remains solid. Leverage isn't a major issue yet. With a PE ratio of 11.6 and a PAG ratio of roughly 1.4, point to a stock that is cheap relative to long-term growth. Lululemon has a strong brand and efficiency, but is vulnerable to tariffs, slowing US demand and execution risks. With the stock down 50% year to date, Lululemon offers upside if management stabilizes US growth and adapts to the tariff environment. But if consumer softness deepens, the cheap valuation may not be enough to offset further downside. What's your take on Lululemon? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.